while you're doing that, if you want to end up reading the disclaimer so we can kill two birds with one stone here.
Okay, yeah. So while we're getting started, just Capital Discussions is not a broker-dealer or an investment advisor. The presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations today, and the risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So there we go. So you've got it, Jim.
Okay, you guys see, this is the chart that I end up using for the technicals. This is my oscillator page. I use all the different oscillators, you know, MACD, stochastics, RSI, Williams percent R, and TCI. And you can see that almost all of them have kind of reached a topping pattern. We've also ended up reaching here the 50-day EMA that kind of has looked like a resistance for the last couple of days. So, you know, when I take a look at this, if I was to go out and draw a longer term line, I have lower lows, lower highs, you know, all year long practically. So this looks like we're almost hitting a short-term high, and we're starting to roll over. That's what the technicals say. I don't trade it, so I wouldn't end up, you know, taking a lot of stock in the opinion. I'm just reading the tea leaves of the charts. Is that reasonable? Any questions on that? Otherwise, we'll give the ball to Joe, and then we'll get started.
Looks like everybody's happy with that. So with that, welcome, Joe. You were formerly at Options Express, right? And now you're with Trading Block?
That is correct. Yeah, I spent 13 years at OX building that up. Schwab came in and purchased us, and I spent 3 years under the Schwab OX moniker, and then took the opportunity to move over to Trading Block and Money Block and work with Steve Hoffman and Tom Heffernan and team building out some really neat, cool things that I'm really excited about talking about today.
Well, great. Well, it's a pleasure to have you here, Joe, and you've got the ball, so you can go ahead and share your desktop and get started.
All right, great. I appreciate it, and I appreciate everybody's patience. I know that I was supposed to be on at 3:30, so I do apologize for not being on. You know what? Let me just do this real quick. I should be sharing right now, but let me. Okay.
Yep, I see your desktop.
You see my desktop? You should be seeing the PowerPoint right now.
Yep.
Okay.
Got it.
All right, well, great, and I really appreciated everybody for having me on today, and you know what, I guess it couldn't be more of an appropriate time to talk about, you know, not only swing trading and swing trading options, but specifically option spreads, and we're in this midst of not only what we haven't seen in a long, long time, which is some high implied volatility, but also earnings season. So today what I want to actually cover is trading option spreads in a swing trade situation. And if, in fact, you are new to option spreads, don't worry. This is definitely something that I will cover so that you'll understand the mechanics. But the best part is that there's going to be a logic chain in here that you're going to be able to follow. Some of you might ask, okay, Trading Block and Money Block. First of all, Trading Block is a self-directed platform that you can go and trade these very strategies that we're discussing and take a look at the markets, and it has execution features that are second to none. If you're interested in getting a little more guidance, working with an investment advisor like myself, as a matter of fact, I am an investment advisor on the Money Block side, and you want to use an advisor whether to manage fully or to actually work with and seek some guidance while you're going through this new journey, check out Money Block. You can always contact me directly on any of this information by just emailing me at support@moneyblock.com. Now, normally I would have a partner of ours, Vlad Karpel from TradeSpoon, on with me as well, because we're going to actually bring in some of the technology that they have over at TradeSpoon, but he is not able to make it today. And so with that being said, I do have to do some disclaimers real quick. about TradeSpoon and our relationship as far as AOS and who Vlad is. He is the founder of TradeSpoon and also is an employee of AOS, which does business as Trading Block and Money Block, a registered broker-dealer, FINRA, NFA, SIPC member, and a registered investment advisor. TradeSpoon and AOS are not affiliated companies, and the content contained in TradeSpoon is not endorsed by AOS. AOS has an advertising and marketing arrangement with parties that are not registered or regulated as broker-dealers, such as TradeSpoon. And as part of these arrangements, AOS pays fees or provides other forms of compensation in exchange for marketing. Any content and tools that are provided by either AOS or by TradeSpoon in this video are for educational purposes only and as well as informational purposes only. Any stock, option, or future symbol that's displayed is for illustrative purposes only and are not intended to portray a recommendation to buy, sell, or hold any security or underlying asset. Myself, or anybody else in the TradeSpoon team that might be involved in this particular presentation, which is just me, may have a financial interest in the securities that are represented here. And again, that I just want to fully disclose that before we get started. And I also need to reference that I am not endorsing TradeSpoon or their tools or technology. I am not an affiliated person with TradeSpoon. But we will have to, I will have to cover some of the tools and applications as they are referenced in the presentation today. And as always, options do involve risks or may not be suitable for all investors. Take an opportunity to read the characteristics and risks of standardized option. Go to the optionsclearingcorp.com website, or you can go to moneyblock.com or tradingblock.com. Sorry, guys, have to do it. I'm a regulated guy. All right, so let's actually jump into why you're all here today. What we want to do is talk about swing trading, and first I just want to get out and specifically swing trading in bear calls, in call spreads and put spreads. It should actually be bull call spreads and bear put spreads, so I apologize. I don't know why that got switched. But what is swing trading? Now, there are various definitions out there, but really it's just a style of trading that attempts to capture gains in a short period of time. Now, there's two things that I want to define as we before we go forward, and that's profitability and probability. These are very intricate parts of the logic chain, and that'll become more abundantly clear when I talk about probability analysis and also how I look at profitability. And then really, profitability in my world is defined as break even or better. Some people might ask, well, how is that profitable? Well, basically, after expenses and getting in and out of the transaction, if you get out unscathed, in other words, you have the same amount of money as you started with, to me, that's profitability. Yes, I know that you're not sitting there saying that you are walking away saying that you are now a millionaire, but it is profitability. Probability is the probability of any trade to achieve break even or better. So when I say the probability of X, like is 60%, that means that it has a 60% probability of being break even or better. Okay. So I'm going to pick out for looking at a long bull call spread, I'm going to pick out one stock. Now, one of the things that I'm going to do this real quick, if you can bear with me for a second. I want to move this slide up, and I'm actually going to scroll down. This is the beauty of doing this live because I can make intricate changes really quick and have them. Okay. Okay. So I'm actually going to jump in here. So the question that you might ask is, how am I going to find out what I'm actually going to trade? And this shouldn't be a long bear put spread. Oh, I am just cooking with gas today. That should be a long call spread. And I don't know why that is up there. So I apologize. Oh, boy. Has anyone ever had one of those days? I think I'm having one of those. And I have no idea why these are all misaligned. So I apologize, folks. Hey, guys, are you still there?
Yeah, we're here. Not a problem.
This is, you know, I figured at least my trading's going well. A heck of a lot better than my actual presentation right now. But hey, all right. So, man, I can't believe this is not set up right. All right. Okay, I'm going to put this one up here, and then we'll go from there. I'm feeling like Danny Sheridan should jump on right now and make me feel better about myself. Okay. All right, so let's just get this thing started. We'll make adjustments as we see fit. All right, so basically, how are you basically going to figure out what you're going to trade when you're thinking about a long, and this should be a long bull call spread? Well, basically what you can do is you can use the TradeSpoon Trade Idea tool. Now, for those of you that aren't familiar with TradeSpoon, it is a site that Vlad Karpel had developed and is the founder of. And basically, they built proprietary scoring technology utilizing a plethora of different research criteria as well as technical components. The previous gentleman was talking about, the technical components of gold. Well, the algorithm actually incorporates that along with some fundamental components, and it will also incorporate options information like implied volatility. And what the TradeSpoon Idea tool does is it will then screen the market based on the criteria that you put on for the short-term rating and the long-term rating. So you can see that I'm looking at a scale of 0 to 10. Basically, that means 0 is the most bearish rating, and 10 being the most bullish, and this is for the short term. Short term is defined as anything over the next 50 days. So if I'm looking at a short-term rating of 10 and a long-term rating of 6, which is basically middle of the road, this is what the actual platform brought up. And it had two stocks, Swift, SWFT, and Nike. Now, the reason why I wanted to look at SWFT was because there's a binary event. And that binary event is earnings. And so once I find the idea, now I want to go in and actually look at what the stock action has been in the past. So when looking at Swift Transportation, and by the way, since this is a transport, you could look at the transport ETF IYT, which basically you could get a feel for all of the transports that represent that ETF and see how that actual sector ETF has been performing. But just looking at the stock, you can see that the stock has been in a range between 20 and 26. Now, again, I am not a technician, and this is a technical analysis class. But as I said, I'm going to look for a long bullish opportunity with the stock that has shown some weakness, and specifically it showed weakness over the summer, and then basically it's been consolidating at this $20 level. Now, it does have a binary event, which is earnings on the 23rd right here. So with that in mind, and I'm looking at this particular stock that has a defined range, at best you're thinking it's neutral. But I'm getting slightly bullish because the transports have been bullish up until, well, basically this week. And so with that being said, I'm looking for a bullish setup. But because it's been in this consolidation, I'm going to use the bull call spread because you remember with the mechanics of the spread, you're buying one call and you're selling another to offset that purchase price, which gets us into two things. One is how can we use the statistical analysis of probability to help us determine strike price selection. And how we use it is that I will look at the probability of a stock price being above and below a certain level. So in this case, the probability of the stock being above 23.26 is around 26% at expiration. Now being below 17.62, it's 33.19%. Now I'm getting this information again from TradeSpoon, and so you can see that the probability of being between 17 and 23 is roughly 40%. Okay? And so if I'm looking at this and I'm buying the $23 calls and I'm selling the $25 calls against it, I basically have maybe a 25% probability of potentially having any type of profit at expiration. That to me is telling me that, you know what, unless this thing has an enormous push to the upside, I'm looking at a very low probabilistic idea. So I'm going to have to probably scale this into a position that's going to be slightly more conservative. In other words, the option that I'm going to buy is going to be deeper in the money based on the probability analysis that I've actually done here. Now what you can do is that then you can go into trading block and you can go in and use our trade builder tool where you put the stock symbol in, your target price, the date of expiration, which happens to be the third week in November. I'm looking at the normal expiration cycle, and the investment you want. And the system will come up with the highest probability of profit ideas that, first and foremost. And then you can look at it and say, well, this meets my risk tolerance and objectives. What do I mean by that? When I was looking to buy calls, I'm willing to give up that unlimited upside, so sell a call above it. So that means I have fixed risk, but I also have fixed return. And I want, in the case of doing these bull call spreads, in other words, these debit spreads, at least a 60 to 65% probability of having potentially any profit at expiration. And this is where we go awry again, but I'm just going to pull this one down to here. And we are going to go back to this one. So looking at the P&L components along with the probability analysis, you can see that I'm buying a very deep in the money call. In this case, it's the November 15 call, and I'm selling the November 20 call. This is a deep in the money call spread. There's two reasons why I'm doing this, and as a matter of fact, we were looking at this a couple days ago. The reason why I'm doing deep in the money is because I need a high probability trade. The environment, in other words, the overall market environment had turned extremely bearish and continues to have some bearish, a strong, high amount of volatility and potential violent moves. So to me, taking the more conservative approach where, in this case, as I said, I had risk capital of $2,000 that I'm willing to pull up. The total P&L at expiration would be about $109. $109 on $1,800 worth of risk is basically almost a 6% return on the capital. To me, the risk reward makes sense. And I am in this business to hit singles and doubles, not home runs. Some of you may not have $1,800 to put in a position, but the bottom line is if you had a couple $100, you could actually do one contract, right? One or actually, I don't even know if you could actually do one contract. But the point being is, I'm sorry, I have a little echo here. So the point being is that I'm trying to get a high probability opportunity on in something that has a binary event over the next week and a half. Like I said, it has earnings on the 23rd. So in fact, if stock does bounce from here, if SWFT does bounce from here, and I can get a nice push over the next week to 10 days, I could potentially take this position off for a nice little profit. And again, if you typically have about anywhere from 5 to 10 of these different positions on, and you're taking off return on capital of somewhere between 2.5 to 20%, you're going to see that that's going to add up quite quickly. All right, now let's shift gears and actually look at a swing opportunity if you were bearish. Now, first and foremost, what are you going to trade? This is where, again, you can go in and use the TradeSpoon trade idea tool. The criteria that I'm going to utilize here is that I'm going to have the short-term rating is 0. And the reason why I'm putting the stress on the short-term rating is because I'm looking for a short-term trade, in other words, 50 days or less. And I would like to have something that has a long-term neutral perspective. Really, I'm just trying to play the short term. Well, you can set that up with the trade idea tool at TradeSpoon by just putting 0 and 5, and then it will give you the top ideas that fit that criteria. In this case, I'm going to look at Campbell Foods. It is CPB, good. Yeah, everybody knows this. You see the price information for the day that I was looking at it. Stock was trading at 42. It was down 0.4%. The stock overall year-to-date is down 2%. Support's at 41.22 and resistance is at 43. And you can see that the short-term trend is very bearish at a 0. and that's over the next 50 days. You can see that the long-term trend is basically a perspective of anywhere between 12 and 18 months. So about a year to a year and a half. You could even go out as far as 2 years. But again, I'm looking at the short term. Looking at the stock, you can see that there is a base at 42, and it's been scaling down. In other words, been in a bearish trend, right? Not a hugely bearish trend for most of the summer, and then basically it's been consolidating over the last month and a half. I do have a binary event, earnings, on the 18th of November, which is within the expiration cycle of the November options that I would be looking at. So again, you're sitting there going, okay, I have a stock that's been trending bearish and been consolidating lately. That consolidation now is getting to a potential point where it could tip either way. And if this stock has been in a negative trend when the overall market has been going to the upside, if the market does get ugly, this one could actually turn tail and even amplify that bearishness. So let's take a look at the probability analysis to start giving us perspective on potential strike selection for a bear put spread. So you can see that the if you're looking in the range of basically around 39.55 to 44.69, well, the probability of being on to the upside number is around 17%, and to the downside number is 39.55. This means basically that there's a 56% probability of being between 44 and 39 at November expiration. In other words, over the next 50 days. Again, this is going to help me understand where should I be looking to purchase these puts. If I were to purchase the $40 puts right now and sell maybe the, whatever, the 37.5s and do that 2.5 point spread, you're basically looking at a trade that has probably less than a 30% probability of being potentially profitable. Why would I do that? So again, I'm going to have to look at that 42 level, maybe even that 45 level in this particular situation. Again, where would I go? Go to tradingblock.com, go to Trade Builder. Here you go. You can put in the pertinent information, the stock, your target price, which was 40. And you could use the target date as well as the dollars that you want to put at risk, and then it'll give you a high probabilistic idea. Now, the one thing that I want to highlight is we're going to cover the bear put spread and the buying that put spread. The reason is because that fits my risk tolerances and objectives. I may be new to this, or I'm new to spread specifically, and I'm just not prepared to sell spread strategies and do credit spreads. Right? Now, the one thing that I want to point out why I'm highlighting this is because if you look at the probability of profit on the debit spread, in other words, the bear put spread, it's around 51%. Okay? And if you look at the probability of profit of doing the call credit spread, you see it's at 63%. So it's an opportunity to start learning more about more strategies that you could implement that fit your sentiments, which in this case I'm bearish. But again, it may not fit your risk tolerance. In this case, I'm risking 18.55 to make 2.45. And here, again, I'm risking 17.85 to make 3.15. The thing is that if the market stays at the level where it's at now, I will capture that 2.45. And you know, basically, or if it goes up or down, I will capture that 2.45. Now, if the market sits there or goes up, I'm going to risk 17.85. So again, you got to look at the risk reward and really have the conviction. And that is not the slide I wanted. I apologize. Okay. And so basically, I'm sorry, folks. So basically, with this particular strategy, you're going to have to basically take down whatever your risk tolerances and your objectives are. And in this particular case, and I'm sorry, gosh, these slides are all messed up. I've had one of those days. But either way, the point being is that if I can get a move now, and one of the things that I want to do, if I can get an opportunity, if I can get the move basically down to, and I don't know where the P&L chart went, so I apologize, folks. This is a little bit disheveled. But if I can get the move, I'm going to see if I can't find that real quick, but I missed it. I need to move down below that short strike price for me to get full profitability. Okay, and it's I believe it's the 42, the 45, 42 and a half put spread. Basically, it's deep in the money. It's basically trading at a discount comparative to being just short the outright market. And so really, if the stock were to stay here and not move at all, I would have almost a built-in profit. So as time starts to decay here, and again, I have until mid-November, and as a matter of fact, with earnings sitting there on the horizon, if the stock starts to move dramatically to the downside, I could actually take, maybe a 50% profit, or in other words, take in, 150 to, $150 profit, which doesn't sound like a lot. But the point being is that if I'm taking in those types of returns, you can see your return on capital for the individual trades really start to catapult. And you know what, I want to jump on the website in a second, but before I do that, just to kind of show you how this actually works in practice, because PowerPoint, obviously, this one's so messy. Here's what I want to offer to everybody right here and now before we move forward, because I think this is powerful. If you go and check out Trading Block, I will basically cut your commissions to 50 cents per contract with a 250 minimum. What does that basically mean? That basically means that if, for example, you did one of the spreads that we talked about today, whether it is a bull call spread or a bear put spread, let's say you did a 2-contract spread. That's 4 total contracts. That's $2.50. Okay. If you did 3-contract spread, that's just 6 total contracts. That's $3 a spread for that spread ticket. All right. That basically, if in fact you were trading at somewhere like IB or Thinkorswim or Trade Monster, Option House, which is now the same thing, or Options Express or Trade King, I'm reducing, even against IB, I'm reducing your trade costs by 50%, right, at $1 a contract. So this is a great do, and all you have to do is basically sign up with Trading Block, and also my good friend at TradeSpoon, Vlad Karpel, wanted me to mention that if you want to utilize their service, they have what's called the TradeSpoon Elite service, which basically encompasses all the research tools, applications. They have proprietary picks that they give out on a daily and weekly basis, all of this different information, plus they have portfolio construction and rebalancing tools. That's all yours for $67 a month. So you're going to basically have a $30 savings if you open up a Trading Block account, and you can open up a TradeSpoon account. So, I think it's a great value, and I think that you can all see that you could take an opportunity to basically cut what most people are really focused on and should be focused on, which is your trading expenses, by cutting it to 50 cents a contract and 250 minimum. So if you're a 1 to 3 lot trader, you're going to be basically trading, $2.50 at Trading Block, and I think that's a great value, especially with the great execution features and so forth, and other tools that we have too as well at Trading Block. And I've left my email address up here, so that if you want to get a hold of me, and if you forget Joe Cusick at moneyblock.com, just do support at moneyblock.com and say I'm interested, and you can definitely get a hold of me that way. Let me do this. I actually want to bring up the website if I can. Yeah.
Hey, Joe, while you're doing that, we did have a question. Ray asked, are there any charges for cancels or replacing of orders?
Great question. Absolutely not. The only time you're going to be charged is when you have a filled trade. That's it.
Okay, I had another question. On these trades you're showing, do you ever do adjustments, or you just set and forget them?
You know what? That's a great question. For the most part, I don't do typical adjustments, because here's the thing. I've sized it appropriately so that if the trade actually works against me, so in other words, I put about 1.5 to 5% of the total portfolio into any one position. I know if it just goes totally south on me, I can live to fight another day, because I put in that high probabilistic idea. The only thing that I do for debit spreads, if I see in a very short period of time, let's say after the first 5 to 7 days, I see about a 50% profit from my entry, I pull the trigger. If I see that I have basically around a 75 to 90% profit and there's less than 2 weeks left, I'm pulling the trigger, I'm getting out of it. So that's how I would manage it for debit spreads. For credit spreads, basically my rule of thumb is I've always taken off, once I get 50% of the total credit received, in other words, it's decayed down so that if I sold it for $1 and it's now trading 50 cents, I cover it.
And then do you have any rules for cutting your losses if it's moving against you?
Nope. Basically, if anything, on credit spreads, I do have one rule. If it goes about 150% of the net of the total credit that I received against me, I would potentially close it. But really, what I do is instead of making adjustments or closing it, I sized it appropriately beforehand. I can pretty much so guarantee, and I don't make many guarantees, but almost everybody that's on this webinar, including myself, the biggest issue you have, you've sized too big. And so that's where you need to basically take a step back and make sure that when you're putting these positions on, that you're not putting more than 1.5 to 5% of the total capital in your account at risk in any one position. That's going to be a struggle for individuals that have $1,000 or $2,000 accounts. But that's a rule of thumb that has kept me in the game as long as I have been in, and it's been over 20 years. So,
good advice.
Let me actually jump in. I want to actually, and if someone wants to throw an idea out there, actually, let me just do this. This is actually, I'm logging into the Trading Block website right now. And as a matter of fact, I'm going to do two things here. One is, I always hate this doc. All right, let's do this. You guys want to have some fun here?
Sure.
Do you know what the marks were at the end of the day? Where did the S&Ps go out?
I'd have to look. Let's see.
Well, let's just say, for example, the market's just been completely getting whacked the last the last two sessions, right? So
right.
I don't know what your philosophy is, but I always like to buy in weakness and sell in the strength. Okay. So basically what I just did was I just jumped in and I looked at the TradeSpoon bulls. And what I did was I want to look at the most bullish short-term and the most bullish long-term underlyings that I possibly could. And again, I'm not endorsing this or recommending that you do any of these, okay? But basically what I want to do, and you can see that a lot of these stocks have been up, first of all, year-to-date, a ton, and except for APH. And you see that today, they've rebounded quite nicely. Okay, so you see how they had the short-term ratings. So let's say that I wanted to do a bull call spread in something because I was looking for a bullish idea and I'm looking for something that's been beaten down recently over the last few sessions. Well, we got support at 29.98. Tech's been beat up, and tech is usually one of those sectors that if we're going to have a continuation to the upside, this could be one. So I have Intel here. It has a 910 rating. If I click Analyze here on the TradeSpoon side, this is where not only do I have the fundamental and technical components already done for me as far as their proprietary scoring on the short term and long term, but I can go down and do the probability analysis. Again, what am I doing here? I'm starting to think about if I am bullish, right? This is confirming some of those bullish sentiments with the research from TradeSpoon. If I go in and now look at what's the probability of it being above 34, which is roughly around 16%, and below 27, which is 22%. So there's a 61% probability of being between these 2 points, right? This is basically one standard deviation out of the money for both the downside and the upside. So having that in the back of my pocket for Intel, and knowing that there's a low probability of being above $34, I'm going to look at this and I'm going to say with the stock trading at 29, there's a couple cool things that I can do here. First, what I want to do is I'm going to go in and look at the charts. All right, and I'm going to type in INTC. Now we are upgrading our charts, you know, and you can see that the stock was down 42 cents. So I'm not really concerned about looking at the price action of the stock. I'm really more focused on looking at implied volatility and where that is at, and that's actually the green line right here. And you can see that implied volatility, the mean, or in other words, the average is 1950 for Intel, and it's currently at 3208, which is basically over almost 4 times its median or mean, right? So in other words, it's 3 standard deviations above where its average is. It's exploded, okay? So there's a heightened sense of potential movement in the underlying. I'm going to do something really cool here. We usually have a calculator. We're actually reworking the calculator right now, not this one, but an estimated move calculator on the platform. But I'm actually going to show you how you can go in and do a 30-day move calculation. And basically what I do is take the current implied volatility. I take the current implied volatility and I multiply that times the current stock price. So the last stock price was, let's just use 31.27. So 31.27 times its implied volatility, which is 0.3208, all right, is equal to 10.03. Now I divide that by the square root of 12. And why? Well, because there's 30 days in a month and there's 12 months in a year. And I want to look at what's the estimated move being priced into Intel between now and basically November expiration. So I divide that by, and that's like I think it's like 3.21. It's close enough. So they're pricing in the potential of Intel moving about $3.12. As a matter of fact, it's actually 3.4, but it's close enough. So we'll say $3. So if the stock is currently trading at $30.85, it's pricing in the potential to move either up or down. Again, that estimated move is not directionally biased. It's just saying around $3 is being priced in for potential movement. That means that it could go up to basically 33 and some change, or potentially down to 27. Somewhere in that range, you can split it in half. In this case, what I'm going to do is I'm going to say it's going to move. I'm estimating that it could move potentially $1.50 over the next month. And so I'm now going to go into our trade builder tool, and I'm going to type in Intel. So I type in Intel. You can see that. It'll pop up now. It says, okay, and basically I think that it could get to, let's say, potentially $33. And I believe that that can happen by November expiration, which is the 3rd Friday. I'm going to use the normal expiration cycle. Now, some people might want to use weeklies or whatnot. I'm going to put $2,000 into the position because I have roughly around a $30,000 account. I click Find Trades, and here we go. I can click probability of any profit, and what the system will do then is give me the highest probabilistic trade, and it'll mark it out against the basic underlying strategy if I was bullish, typically buying stock. It'll give you the components of the trade. So in this case, it's this one's selling a put spread. Well, again, let's say that even though this says a 69% probability of any profit, I may not be comfortable selling put spreads yet. So I'm going to scroll down and I see, oh, buying a call spread. It has a 60% probability. Check that. You know, as long as it's in that 60 to 65% probability, I can view the P&L graph. So when I click this, it's just going to give me a very straightforward profit and loss graph. Now you can look at it based on true just profit and loss, value, or percent return. You can scroll down and also take a look at not only your your risk capital that you're putting in play. So I'm looking at doing 9 contracts, so that's why I came up with 1926 as my risk capital. The total profit, if the stock were at $31 at expiration, would be $518, which is a 26.92% return. This is a spread that is in the money, or slightly, almost in the money right now. So, you know, if I click trade, and here we go, and here if I could basically pick this particular spread up at pay for $2.14 for this. As a matter of fact, if I pay $2.14, I'm basically saying that my break-even point is roughly with where the trade settled today, or where the stock settled, let's just say at 30.80. I basically have around 70 cents of downside before I'd even be at break-even on this spread. So if the stock were basically to stay at this level, I would have a recognized profit if the stock never moved again. All right. Now, as small as that might be. Now, if it goes out above 31 at expiration, I am actually going to recognize that profit of basically, and this is a $3 spread. So basically, you're looking at 76 cents, or excuse me, 86 cents 9 times. That's where we came up with that 500 and some change. And here's the other thing that I want to point out. So I'm doing 9 contracts. That's 18 total contracts, which basically means that you will be basically, it is roughly around $7.15. And I apologize, I forgot that this account doesn't have any money in it, so I can't place it. But as a matter of fact, we do have a virtual trade, and you can actually place this trade virtually, and I could actually show you how to do that. So are there any questions that have come up as I walk through? And you could see how quickly I walked through that logic chain. Are there any questions that have come up on that?
No, I don't see any questions.
All right. That means I must have done just one hell of a job explaining all of this.
Well, we have pretty sophisticated traders, so I think they're following pretty well.
Yeah, I mean, it's a straightforward approach, but the biggest thing that I can tell you right now is that the hardest part of trading is going in and trying to find those high probabilistic ideas. Utilizing a tool is one way that you can go out and streamline that whole process. The other thing is using prudent capital management. And, you know, as you were asking about maintenance and things that, or adjustments, the one thing I wouldn't like to do is let's say all of a sudden the stock just sits here right now. One of the adjustments that a lot of you, since I know that, you know, Danny has been teaching this for a long time, is one of the adjustments to this trade that you could do if you have conviction that the stock isn't going to go above 31 is you could basically do the 31, 34 call credit spread, take in some extra capital, and then basically have a huge butterfly. And you could even do it broken wing butterfly, however you want. The bottom line for me is that that's not, it is an adjustment that you could make, and I'm not saying that it wouldn't be a prudent adjustment. It's just something that then adds another layer of risk that I may not have had, you know, intended to put on with my original sentiment. If my sentiment's changed, then I could make that adjustment. I like to put the strategy on, not so much set it and forget it, but manage the winner. So I'd manage the untested sides. I wanted to manage the winner. So if this thing started trading at somewhere around 275, I would close this thing down, especially if it happened in a very short period of time. So that's about all I have today. And again, I apologize for, you know, Tom and Jim and everybody for some of the snafus with my presentation. And I do have to admit, I got caught kind of in a bind. I'm supposed to be driving to Minnesota right now for a hockey tournament. So I truly apologize with my scheduling snafu. So
no
I thank you for your patience. And you know,
are you playing in the tournament or watching it?
No, no. It's my oldest daughter. It's the Minnesota high school hockey championship. Basically, they bring in the top women's hockey teams at the U16 level in the country. There's going to be 65 college coaches that are going to be hanging around all weekend. She plays on the number 3 team in the country. And so I got her looking in my office as looking at me going, are we leaving yet? Because she has 2 games tomorrow. Yeah.
Right.
So, but you know what? I look forward to doing these discussions. And again, while I took a simplistic approach, I think that if you can put the logic chain in a very straightforward manner, the intricacies of this start to really clarify themselves so that it's not. So, for example, just the last 3 days have been the best trading days that I have had. And just to put this in perspective, 80% of my portfolio was long equities, right? And the one thing that I did, and you might ask, well, wait a minute, 80% of your portfolio was long equities, and the market was down, in some cases, if you were, whether it's small caps or large caps, and I'm primarily large cap focused. I had 9 names, 80% of it in equities. I actually was up 5% on the net portfolio because the other 20% of the portfolio I had in a volatility exposure. In other words, I was long VIX, and I structured it so that the way I actively managed that part, and I structured it in such a manner so that when you have, and I wanted to put VIX there because it's a pure non-correlated asset, and bonds right now at this juncture, from a price risk perspective, are way out of whack, and bonds are highly correlated with the market, and I wanted to have a non-correlated asset class, and I will always have. So just as a ratio to throw out is something that I don't know if everybody on this has ever looked at it from this perspective, but for every $4.50 that you have in equity exposure, you should have at least $1 of volatility exposure. So keep that in mind going forward when you're thinking about portfolio construction. And if you ever have any questions, you can email me at support@moneyblock.com, and we can always set up a time to talk more about that.
Sounds great, Joe. I appreciate the presentation. I don't want to keep you too long. There's no more questions. So have a safe trip and a great weekend.
Thanks, my friend. I'll talk to you later.
All right. We'll see you. Thanks, everyone.